Martin is 62, lives in Leeds, and he's been careful with money his whole life. When his daughter needed help with a house deposit, he knew exactly where to look. His pension pot had £100,000 sitting in it. He wanted to take out £20,000, which he'd worked out was comfortably inside the 25% tax-free limit. He'd done the sums twice. He was sure. 2 days after he made the withdrawal, an email came through. HMRC had applied an emergency tax code to his payment. Nearly £3,000 had been withheld. Not because he'd done anything wrong, not because he'd broken any rule, but because the system had looked at that single £20,000 withdrawal and, using something called the month one basis, decided to treat him as though he was earning £240,000 a year. The algorithm doesn't know it's a one-off. It assumes whatever you pull out in month one, you'll pull out every month for the rest of the year. So it taxes you accordingly. Martin could get that money back eventually, but he'd have to fill in forms, wait for HMRC to process them, and explain himself to a system that had already made up its mind. Meanwhile, his daughter's deposit deadline was ticking. The frustrating part is, there's a way to avoid this entirely. It cost £100 and about 3 weeks of patience. That's it. Martin hadn't heard of it. Most people haven't. And that's what this video is about, because Martin is not an edge case. This happens to thousands of people every year who do everything right and still get ambushed on the way out. Before we get to the £100 fix, it helps to understand why the tax system behaves this way. Because the deeper problem isn't just the emergency code. It's something quieter, and it's been building for a few years now. Most people approaching retirement carry a mental picture that goes something like this. I have a tax-free allowance of £12,570. My pension withdrawals are modest, so I should be fine. That picture made sense once. It doesn't quite anymore. Here's what's changed. The personal allowance, the amount you can earn before paying any income tax, has been frozen at £12,570 since 2021. The government hasn't moved it. Meanwhile, the state pension has kept rising every year under the triple lock. In 2026 to 2027, the full new state pension is sitting at roughly £12,548 a year. Do the subtraction. £12,570 minus £12,548. Your tax-free buffer, the gap between your allowance and your state pension, is now approximately £22 a year. That's not a meaningful buffer. That's the cost of 2 pizzas. It means that for most people receiving the full state pension, almost any money they pull from their pension pot, even a relatively modest amount, lands in taxable territory straight away. Every pound above that £22 gap gets taxed at 20%. There's no longer a comfortable zone to withdraw from quietly and cheaply. I'll be honest, a few years ago I thought the freeze was fairly minor. One of those political adjustments that sounds significant in a headline but doesn't really change much day to day. Then I sat with someone and looked at their actual tax position, and it clicked. His state pension had crept so close to his allowance that he was paying income tax on pension withdrawals he genuinely believed were tax-free. He wasn't wrong to believe it. That's just how it used to work. The system changed underneath him. Nobody sent a letter. And here's the thing that makes it worse. The freeze on personal allowance isn't scheduled to lift until April 2028. So this isn't a temporary glitch. For the next couple of years at least, this is the reality. Your state pension will continue rising. Your allowance won't. The gap will only narrow further, or disappear entirely before anything is adjusted. It's worth pausing on that. If you're 62 or 63 now, you're planning withdrawals in an environment where your effective tax-free space from a pension is close to zero, assuming you're drawing the full state pension. That's not a reason to panic. But it is a reason to plan differently than you might have done 5 years ago. The system isn't broken. It's working exactly as designed. The problem is that most of us are still running on an older mental model of how it works. One where there was breathing room. That breathing room has largely gone. Controlling the emergency tax code is step 1 to keeping your money where it belongs. But now you also need to know exactly how much space you actually have to withdraw from, because the assumptions most people are making are out of date. So how does the emergency tax code actually work, and how do you get around it? When you make your first taxable withdrawal from a pension, HMRC has no file on you yet. They don't know your income. They don't know your tax code. So the system defaults to what's called a month one basis emergency code, which essentially takes whatever you've withdrawn and multiplies it by 12 to estimate your annual income. If you pull out £20,000, the system assumes you're on a £240,000 a year income and taxes you accordingly. That first withdrawal triggers everything, and it's almost always the most expensive one. The way around it is straightforward, though it's not obvious unless someone's told you. Before you make the withdrawal you actually need, you make a much smaller one first. Specifically, you withdraw £100 from the taxable portion of your pension, not the tax-free cash, but the taxable element, a small, deliberate test transaction. That £100 will get hit with emergency tax. You might lose £20 to £40 on it temporarily. That's the cost of the trick, and it's worth paying. What that transaction does is prompt HMRC to open a file on you. Within a few weeks, they'll issue a proper tax code to your pension provider, one that reflects your actual personal allowance and your real circumstances, not a worst-case estimate. Once that code is in place, and your provider has confirmed it, you then make the withdrawal you actually wanted. The difference, instead of losing £3,000 on a £20,000 withdrawal, you lose perhaps £20 on a £100 one, wait a few weeks, and then take out your money at the correct rate. No P55 form, no P53Z form, no waiting months for a refund while HMRC processes your paperwork. You're not gaming the system. You're giving the system the information it needs to work properly, just in the right order. There are a couple of things worth knowing before you try this. First, the timing matters. Once your pension provider receives the updated tax code from HMRC, confirm it with them before placing the larger withdrawal. Don't assume it's arrived. Check. Second, this only helps with the emergency code issue. It doesn't change how much tax you owe overall. If the withdrawal pushes you over your personal allowance, you'll still owe tax on the portion above it. The trick controls the timing and the cash flow. The underlying tax liability is a separate question. You're trading a short delay, 2 to 3 weeks typically, for a much smoother transaction. Your money arrives without a large chunk held back. You don't have to chase anyone. You don't have to explain yourself. For something like Martin's situation, helping a daughter with a deposit on a deadline, that's not a small thing. Cash flow matters in the real world. Controlling the tax code is the first layer of getting this right. But there's a second layer that catches people just as often, and it's hidden inside the moment that feels like the easiest part of the whole process, pressing the button to take your tax-free cash. Here's where things get genuinely counterintuitive, and where I've seen people make expensive assumptions without realizing it. Most pension providers, Aegon, Hargreaves Lansdown, Vanguard, the lot, have online portals now, clean interfaces, simple buttons, and when you log in and navigate to drawdown, there's usually an option that looks something like this: take your tax-free cash. You type in the amount you want, you click confirm. It feels simple. It feels free. It isn't quite either. The rule that governs this is called the Pension Commencement Lump Sum, or PCLS if you want the acronym. The rule says you can take 25% of your pension pot tax-free. What the portal doesn't always make obvious is that you can't just reach in and take that 25% on its own. To access £20,000 in tax-free cash, you have to crystallise, designate, in the legal sense, 4 times that amount. The full £80,000 has to be moved into drawdown together, which means £60,000 that you haven't spent, haven't touched, and didn't necessarily want to move yet, has now been crystallised. It's left the uncrystallised portion of your pot, and it's sitting in drawdown, waiting to be taxed the moment you withdraw it. Martin did exactly this. He pressed the button to take his £20,000. What he didn't fully register was that the other £60,000 in his pot had just shifted status. It hadn't gone anywhere in terms of his balance, but in terms of how HMRC treats it, it had moved. Why does that matter right now, specifically? Because the government has confirmed that from April 2027, uncrystallised pension funds, money still sitting untouched in your pot, will be brought into scope for inheritance tax at 40%. That change is coming. But crucially, pension assets that have already been crystallised and moved into drawdown will be treated differently depending on how your estate is structured. Crystallising more than you need, earlier than you need to, can create complications you didn't intend. It can affect how your pension interacts with your estate. It can narrow your options. And it's very hard to undo. I remember sitting with someone last month. She was in Surrey, had done everything sensibly, had a decent pot put together over decades. She'd logged onto her provider's portal one afternoon, seen the Take Your Tax-Free Cash button, and clicked it. She told me it took about 4 minutes. When we looked at what had actually happened, what had crystallised, what that meant for her estate planning in the context of the 2027 changes, she went very quiet. She hadn't made a reckless decision. She'd made an uninformed one, and the portal had made it very easy to do that. The question isn't whether to take your tax-free cash. For many people it makes complete sense. The question is when, how much, and whether crystallising a larger portion than you need right now is actually in your interest. If you're not spending the whole £80,000, you may not need to crystallise the whole £80,000. That's worth a conversation before you click anything. So, how do you actually structure this to keep more of your money working the way you want it to? There's no single perfect answer here. Everyone's situation is a bit different. But there are 3 things that tend to make a real difference for people in their early to mid-60s, and they're not complicated. The first is knowing exactly what your tax code says before you touch anything. Log into the government gateway. Look at your current tax code. If you see BR, 0T or a K code, stop. Those are warning signs. BR means you're being taxed at 20% on everything with no allowance applied. 0T means your entire allowance has been used up or isn't being factored in at all. A K code means HMRC thinks you owe them money from a previous year and they're collecting it through your tax code. None of those should be ignored, and none of them are difficult to challenge, but you need to catch them before they eat into a withdrawal, not after. A phone call to HMRC or a quick message through the gateway can get these corrected. It's not glamorous advice, but it's the kind of thing that saves people hundreds of pounds for about 40 minutes of effort. The second thing is thinking about the ISA buffer. Most people frame the question as, should I leave money in the pension or take it out? But there's a middle option that often gets overlooked, rather than taking a large lump sum in a single tax year, which can push you well above your personal allowance and create a tax bill you weren't expecting. You can withdraw smaller amounts each year and move them straight into an ISA. The annual ISA allowance is £20,000. Once money is inside an ISA, it grows tax-free and you can access it whenever you want, with no tax on the way out. Susan is 62. She wanted to buy a motorhome, something she and her husband had talked about for years. The total cost was around £30,000. Instead of taking it all in one go, she withdrew £10,000 a year for 3 years, staying comfortably within her remaining personal allowance each time. Each year the money went straight into her ISA tax, paid on those withdrawals, £0. Had she taken the £30,000 in a single year, she'd have owed roughly £4,500 in income tax on the portion above her allowance. Instead, she paid nothing, and the motorhome cost exactly what she thought it would. That's not a loophole. That's just using the system the way it's designed to be used. The third thing, and this one is specifically for anyone who's started to worry about the inheritance tax changes coming in April 2027, is to be careful not to overreact. If you're married or in a civil partnership, transfers between spouses remain completely exempt from inheritance tax. That hasn't changed and isn't changing. So if your concern is protecting what you leave behind, the spousal exemption is still a substantial shield, and it applies to pension assets as well as other estate assets in many circumstances. The 2027 changes are real and worth understanding. But they don't affect everyone equally, and for couples in particular, the picture is considerably less alarming than some headlines suggest. The difference between a straightforward retirement and a stressful one often isn't the size of the pot. It's whether the decisions were made calmly, with a clear picture of what the rules actually say, rather than what we assumed they said. Patience in this process is worth real money. Susan's 3-year plan saved her £4,500. That covered a good chunk of fuel for the motorhome. There's something that doesn't come up much in financial guides, but it's probably the most honest thing to say in a video like this. A lot of people in their late 50s and early 60s aren't withdrawing early because they've done the maths and it makes sense. They're withdrawing early because they're frightened. Frightened that the rules will change again. Frightened that a future government will reach into the pot and take something. Frightened that what's theirs now might not be theirs later. After 40 years of contributing, that fear is not irrational. It makes complete human sense. But here's what that fear is actually doing in financial terms. Every pound you move from a pension into a bank account moves from an environment where it grows sheltered from tax into one where the interest is taxable, where it sits exposed to future estate considerations, and where it loses the structural protections the pension wrapper provides. You're not securing it, you're changing its status. Your pension is one of the most tax-efficient structures the UK system offers. Moving money out of it early, just to feel it in your hands, is swapping a real advantage for a feeling of control, and the feeling of control is understandable. But it has a cost. The question worth sitting with isn't, should I take the money out? It's, what am I actually afraid of? And is moving the money the only way to address that fear? Sometimes the answer is yes. Sometimes there are very good reasons to draw down now, but sometimes the honest answer is that the fear is doing the deciding, not the plan. Your pension pot is one of the better protected assets you have. Don't dismantle that protection for a reason that might not hold up when you look at it directly. 2 things to take away from this. First, if you're planning your first taxable pension withdrawal, do the £100 transaction before you do anything else. Let HMRC set the right tax code. Wait for your provider to confirm it. Then make the withdrawal you actually need. A few weeks of patience is worth several £1,000s of cash flow. Second, before you press the drawdown button to take your tax-free cash, understand what you're crystallising, not just what you're taking. If you only need £20,000, think carefully before designating £80,000 into drawdown when you don't yet have a plan for the rest of it. The 2027 inheritance tax changes make this worth thinking through properly, not quickly. I know UK pension rules can feel like a maze. I don't have a perfect answer for every situation. There are too many variables, and anyone who tells you otherwise is probably oversimplifying. But the 2 traps in this video are specific, well documented, and avoidable once you know where they are. That's why I make these. If HMRC has ever handed you an unexpected tax code, a BR, a 0T, anything that looked wrong, share it in the comments. It helps other people recognize what they're looking at before it costs them anything. And if you found this useful, subscribing to Arthur's UK Retirement Guide means you'll get the next one when it's out. We cover the practical side of retirement finance in the UK, the parts that tend to get glossed over elsewhere. See you next week.